Hey everyone, my name is Daniel and welcome back to another video. I hope all of you are having an absolutely phenomenal day out there. As always, here today, I want to take you all through Celcius stock, a company revolutionizing the energy drink game with a very innovative product. And although the stock has done phenomenally on a year-to-year basis, it is down over 40% in just the past 1 month. So in this video, I want to talk to you all about exactly what's been going down with Celcius stock to cause such a massive move to the downside, as well as take you through the long-term plan for this company, going through their financials, revenues, business model, and take you through my long-term projections to determine exactly whether or not Celcius is potentially a worthy investment for the long term. If you end up enjoying this video, please consider hitting that subscribe button, folks. And with that all out of the way, let's get into the video. So first and foremost, what the heck has been going on with Celcius stock? Down 40%, rebounding a little bit today, but still down substantially. Well, nothing has really changed at the company. We did get a bit of an earnings report, pretty much in line with analysts' expectations, growth on the top line, a bit of a larger loss on the bottom line from my understanding, and that is partially due to this massive supply chain crisis that we're experiencing right now, elevated costs, things like that impacting Celcius's business. Now, despite that, in my opinion, the long-term view and trajectory for this company has not changed one bit, and the stock has fallen 40%. Now, this is mainly due to the major pullback we've seen in a lot of these smaller, high-growth, non-profitable, high-multiple names like Celcius and SoFi and Palantir and DocuSign and Teladoc. The list goes on and on. Celcius has gotten bundled up with those companies because it is a company that's growing significantly and spending money on that growth, sacrificing that bottom line. Now, they are profitable, keep that in mind, but when you look at that sole profitability, they are trading rich. Now, we will go through my long-term models, pricing in a potential fully profitable Celcius, which will come in the coming years, but let's go through what Celcius is and what they do. So, first and foremost, Celcius, as mentioned previously, they're pretty much an energy drink company. Now, I have tried one of their products here, the Celcius kind of orange flavor, and I'm going to be completely honest with you guys, it's awesome. I love it. It is probably my favorite energy drink out there. And the way Celcius differentiates themselves is by providing a much healthier alternative to potentially your traditional Monster or Red Bull, which is generally loaded with a lot of chemicals and sugar and things that you don't really need, which make it taste, obviously this is subjective, but kind of bad in my opinion. Celcius kind of gets rid of all of that crap, fills it in with a bunch of organic, or maybe not organic, but more natural ingredients, obviously zero sugar. And they also have a very interesting niche where they're focusing on the fitness industry as well, which we'll go through in a moment. So their product's great in my opinion, but if you are at the slightest bit interested in Celcius stock, I highly, highly do recommend you try out their product. Go to your nearest Target or maybe grocery store, search it up online, nearest Celcius to you. There's many, many thousands of locations in the United States, so it should be quite easy. But I would do that, try out their product, see it for yourself. We do have exactly where Celcius is selling their different products right here. Again, direct to store delivery distributors, fitness distributors, convenience, natural and traditional grocery wholesalers, and directly to retailers across all retail chains in the United States. Keep in mind, the company has started to expand internationally. I think that will be a big, big driver of growth in the back half of the next 5 years, let's say. But there's a lot of potential for Celcius beyond the United States because they've already established a dominant position in the US and will hopefully continue to do that moving forward. But the major, major potential for them, in my opinion, is internationally into Europe, rest of North America, and maybe even South America. So you see all of this. Also listing here that because Celcius branded products have a dietary supplements panel, they are well suited for non-traditional channels of trade and sell direct to vitamin, specialty, nutritional stores, health clubs, and e-commerce customers. So they've got a big, big niche here. And I think it has a lot of potential, especially in the younger audiences, which the first time I actually saw Celcius was on a YouTube channel with about a couple million subscribers, and this individual went out and said, hey, You know, I generally don't like energy drinks because I get a crash halfway through the day, but this thing's been working very well. That's the first time I heard about it. And ever since then, I've been seeing it actually pop up a lot on like golf channels, things like that. So the product is there. And it has a dominant place in especially millennials here today. And I think it's going to continue grow moving forward with time as people realize that, hey, Monster, Red Bull, they may not be the healthiest options. So that's kind of my opinion on their business model, the potential that it has. This is an absolutely huge market across the world. I mean, you look at the energy drink market right here, energy drink market, TAM, total addressable market. It is a $53 billion market in 2018. And it's expected to reach $86 billion by 2026. This company has a lot of potential to establish a dominant place. And given the fact that energy drinks are generally concentrated within two companies, which own well over half of the industry, Monster and Red Bull, there's a lot of potential for innovation here in an industry that has not really been disrupted. Now, when we look at the actual financials of this company, obviously product is great, 5-star reviews on Amazon. Keep in mind, this is in Canadian dollars. I live in Canada. And it is also marked up significantly because they don't sell directly to Canada. So obviously I did pay a bit of a premium to try it, but it was totally worth it. I love it. I wish they expanded here in person, and kind of looking at regular prices, about $21 for a 12-pack. You look at a company like potentially Monster, some of their products are a bit cheaper, pretty similar pricing, about $19 for a 12-pack here. Celcius is smaller, but they have more caffeine. So again, take that for what you will. But looking at the actual financials of this company, which again, this is one of the most important things to look at the end of the day, it all comes down to the numbers for pretty much every single investment that you make. And in my opinion, product is great. Obviously, one of the risks is a very concentrated market, but I think that may pose an opportunity for them over the long run. So this is a massively growing company, right? I mean, you just look at revenue growth over the past 5 years for Celcius here, 30%, 60%, 45%, 43%, 74%. This isn't a company that has just experienced a one-time surge in growth. They've been growing for many, many years. And from my understanding, this company has actually been around for well over 15 years. I mean, you actually have data here going back all the way to 2005, and you see that consistent revenue growth coming in all the way from here to where we're at now, which is over the last 12 months, $250 million in revenue. You can just kind of see it in the corner there. Now, moving forward, analysts expect continued growth. Obviously, triple-digit growth here in 2021 is just incredible. And this acceleration that we've seen since 2018 from roughly 43% to 74% to 130% is phenomenal. We expect at Celcius to have nearly $500 million in revenue by the end of year 2022. So the company is growing. They're in hyper growth mode with no doubt in my mind, and will probably continue to grow moving forward. Looking at their actual balance sheet before we go through profitability, it's actually a pretty good balance sheet. The risk of bankruptcy at this company is very low, and I'm going to minimize this data here. They've actually started to report a bottom line profit, although small, it's there. And what that means is that the balance sheet is growing on a quarterly basis and money isn't taken away from it. So you look at what we got right now when it comes to the company's actual balance sheet, just over $60 million in cash and cash equivalents. No, and again, I'm just going to kind of draw this out so you see it. You look at short-term borrowings, nothing. You look at potential long-term debt, nothing at this point. This company has no debt. Now you do have some accounts payable and accrued expenses. We don't know what these are. Here we have it. Accounts payable represents the amount which a company owes to vendors for products and services purchased on credit due to customary trade terms within 1 year or normal operating cycle of the company. And you have accrued expenses, which represent the expenses that have been incurred but have not yet been paid for during a given accounting period. Now, you do have some other things that are canceling these out, like accounts receivable. Feel free to read that. But the bottom line, this company has $250 million in current assets and under $100 million in total liabilities. The risk of bankruptcy at this company is low, in my opinion, and that isn't really a big problem, especially when you factor in potential dilution. Very, very low as well, given that this company has no real need for dilution unless they want to potentially acquire a certain company, which we'll see. I don't really think they need to, in my opinion. So next thing I want to do with all of you is take you through my long-term projections to determine exactly where Celcius could be 5 years down the road in terms of stock price and how that potentially relates to a yearly return on your money. So you look at it right here. Again, analysts are expecting right around $500 million in revenue in 2022. And then beyond that, I'm going to assume, hey, law of large numbers might start to kick in and we might get some smaller revenue growth. Now, we're kind of diminishing revenue growth in terms of percentages. So you look at this, I think this is conservative, but the thing is I want to be conservative. I want to assume a pretty probable situation. And then if the company overachieves beyond that, I make more money, right? So if I'm able to make money off of this scenario, which is potentially a bit conservative, it sets me up very nicely from a long-term perspective. So look at it right here. Assumption is that they'll hit $1.6 billion in revenue by 2026 and also hit a net income margin of 20%. Now, again, they're expected to hit 3.5% in 2021. That's expected to rebound up to 6% in 2022 and then potentially grow up to here. Now, why do I think they'll be able to hit 20%? Well, here's why. You want to do a bit of a comparison here, which is with no doubt important to compare companies to other companies within their sector. You look at Celcius currently having gross margins of just over 42% over the last 12 months. Now, from my understanding, this should be closer to 50%. And the thing that drew this number down is the whole supply chain crisis that we are currently in the midst of, raising shipping costs and material costs. Again, Celcius is a drink company. It costs and takes resources to make these drinks, which have gone up significantly over the past few months. So costs have gone up, but in a normalized time frame or normalized period of time, gross margins would be around 50% at this point. So you kind of look at Monster Energy, which we just actually took a look at. They have 60% gross margins. They're a much more established company, keep that in mind. But off of those 60% gross margins, they've managed to get a net income margin of anywhere from 25 to 30%. So Celsius, Monster has 60%, Celsius has 50%. I'm going to go a bit conservative here when we look at my assumptions in a moment and assume a 20% long-term net income margin. So using those two assumptions, we get to a situation where Celsius can potentially get up to a $320 million net income run rate by roughly 2026. Now, I think this is pretty achievable. It is heavily dependent on how much they continue to spend on marketing, which I think will decrease as a percentage of revenue over time. But generally speaking, I think this is pretty realistic and again, is a bit conservative. We'll go through some more optimistic numbers in a moment. Now, using a variety of PE ratios, anywhere from 20 to 40, you get a potential upside of anywhere from 30% to potentially a 3x over the next 5 years. To be honest with you guys, that actually is not too bad. Keep in mind, Celsius, they're not going to be trading at a 20 times earnings multiple, in my opinion. They just have way too much growth ahead of them here. So 30 to 40, in my opinion, is much more realistic. So generally speaking, with these rather conservative assumptions, Celsius could be trading at anywhere from $130 to maybe close to $200 per share by the next or over the next 5 years. And that's a 15 to 20% potential return on your money, which I like to aim for 20%. So that's actually getting pretty dang close, especially when you consider the fact that these assumptions could very well end up getting beaten. I don't want to assume over 50% here, but you could definitely say, all right, maybe they don't kind of slow down their growth as significantly, maybe get $2 billion in revenue by 2026, which considering the fact that energy drinks are an $80 billion market, it's pretty reasonable. You get to that 20%. So am I personally buying Celsius at this point in time? Not yet. I still need to be convinced a little bit more that I'll be able to get that 20% compounded annualized growth rate using a more conservative number. I don't want to bet on a 40 times price to earnings ratio, but if it gets to a point where using a 30 times earnings ratio and using these numbers here, I'm able to get that 20%, which would probably happen closer to maybe $50 to $60 per share, then I'll start building out my position. Currently, I think it's just taking a little bit too much risk on, but if you're a believer in the business, if you believe that Celsius is going to grow significantly, this is probably going to be a 2, 3, 4x stock over the next 5 years, given the numbers that we have now. And this massive drop that we've seen in share price really is not justified, to be completely honest with you. So anyways, those are my thoughts on Celsius. Let me know in the comment section down below what you guys think, but I love the company. I want to be an investor in this, but I just want to see that 20% be almost a given for me before I start dipping my toes in. Anyways, if I end up missing out, it is what it is. I'm already exposed to the markets, but Celcius presents a very fascinating long-term opportunity. Anyways, guys, thank you all so much for watching this video. I really, really do appreciate it. If you want some value, please consider hitting that subscribe button, and I will link the spreadsheet in the description down below so you can edit it, change up the numbers, and put in some different estimates. Anyways, thank you all so much for watching, and I will see you all in the next one. Bye-bye.